Did you know that Teledoc rhymes with truckers? Welcome back to Strongman Personal Finance. In this video, we're going to review the financial statements of Teledoc, my what the hella block. So Teledoc is all the rave in the finance community because the genius Cathie Wood, the manager of all the ARK ETFs, the incompetent clown that has underperformed the S&P 500 over the past 5 years. And if you don't believe me, go check it. She has. Pretty sad, huh? I thought active management was the future. Anyway, Cathie Wood is huge into Teledoc. What is Teledoc? Well, basically you download an app and you get connected to doctors. You don't have to go to the doctor's appointment. You just download an app and use it. And I believe I've used this personally because I've been so depressed by YouTube, by the clowns, degenerates, losers, and poo-poo faces, that I've had to download Teledoc and use it for my own personal sanity. And all these digital apps are great. I mean, I fully support being able to get on the phone and, consulting a physician to see if they can resolve your issue without you going to the doctor. Sometimes you still have to go in, but it is a nice option to have, okay? So the product itself, I have nothing against Teledoc. What I don't like is the financial statements. And what I really don't like is that an incompetent clown like Cathie Wood is all into this stock. Because if she is interested in this stock and she is saying it's becoming the healthcare information backbone of the U.S. and she is bullish on this stock, that's a warning sign that you should probably get out of this very, very fast. Okay? So let's look at the financial statements of Teledoc. The first thing I like to do is look for going concern. I always search for going concern to see if this business is going to go out of business. I apologize. Oh my God. Snafu. I apologize for the loud noise. But apparently this business, according to the auditors, if there even is an audit report, is not going out of business. But if you search for going concern and then you see a statement about substantial doubt about a company's ability to continue as a going concern, that's usually an indicator this company's about to go bankrupt. So now let's go ahead and find the financial statements. Let's look at the balance sheet, okay? So the balance sheet here is a comparative balance sheet comparing December 31st, 2021 to September 30th, 2022. We can see right off the bat that total current assets are $1.2 billion for the 3 months for September 30th, 2022 on that exact date. And their total current liabilities are $411 million. This business is doing pretty good when it comes to the balance sheet, at least for short-term liquidity issues. They have almost $900 million of cash, and they could simply take off that cash and pay off all of their short-term debts. Now, they don't have enough current assets, and they don't have enough cash to pay off all of their debts, but at least they're probably not going to go bankrupt within a year. They have their balance sheet from a short-term perspective is good. Now, the long-term perspective, when you compare long-term assets to long-term liabilities, what I don't like is that this company has a lot of goodwill. Goodwill is when you acquire another business for more than the fair value of its net assets. And we can see there is a massive change in goodwill. Look at this. $14 billion of goodwill. So they spent ungodly amounts of money to acquire other businesses. And that has gone down by $10 billion, roughly, to $4.8 billion. They had some kind of goodwill impairment, which I've talked about before. They had to write down the value of a business they had acquired, and they did that write down basically through reducing the goodwill balance. So if you pay more for a business than it's worth based on its fair value, and you pay more than that, that is recorded as goodwill. And when you figure out later that you may have overpaid for that business and it's not worth what you thought it was, you write down goodwill and it hits your income statement and it generates a loss. So they still have a lot of goodwill. More than half of their assets are goodwill. And you got to think about it. Way more than half of their assets are intangible assets, goodwill and intangibles, okay? The intangibles went down a little bit. I mean, that's probably amortization. But overall, when it comes to a bankruptcy risk, at least in the next year, there's really not that much of a risk. And if you look at their long-term debts, they had this convertible senior notes, okay? I don't know the details on this, but these could probably be converted into common shares. I don't know how likely that is, but we should probably check to see the maturity of these notes. I wonder if we can do that real quick. Convertible senior notes. Because one thing you really have to be careful of is you may see something that looks like a long-term debt, and then you go and see when it actually matures, and let's say this debt is coming due in the next couple of years. Well, that's a big freaking problem. So, let's see. The following table presents the certain terms of the notes that were outstanding as of September 30th. So, we have notes that are due in 4.7 years, notes that are due in 2.6 years, and notes that are due in 2.7 years. So, there is not an immediate risk of bankruptcy. However, when these notes come due, they're gonna come due, okay? And the big baby is this Livongo note, $550 million, and in almost 5 years, this 2027 note. So at the end of the day, I just don't see, these two notes that are coming due in the next 2.5 years. I don't see this bankrupting the business. They could either refinance it, and I believe they're actually generating positive cash flow. They're probably going to be okay. That's my opinion, but we'll see as it gets closer. And on top of that, the interest rates are not really high. Now, you have to ask yourself, if they need more debt, what interest rate are they going to have to pay now? Probably a much higher interest rate. But like I said, these long-term notes are not going to come due for at minimum 2.5 years. And the big one is not due for 4.5 years. So I'm not really concerned about that too much, okay? So overall, Teledoc is not going bankrupt in the next year, in my humble opinion. And I believe they'll be fine with their notes in the next couple of years. But we will see. We always have to double check, okay? So overall, their total stockholders' equity has massively decreased. They have obliterated $10 billion of stockholders' equity. Why? Well, it's mostly because of massive losses, mostly associated with this goodwill impairment that they had to write down. So this company has destroyed a lot of book value. I mean, at the end of the day, even if you took away these intangible assets, I mean, the business would still not be underwater. Well, maybe. If you took away the goodwill, the business would still have more assets than liabilities, which that's probably how you should value the company better, is don't even consider the goodwill when you're comparing assets to liabilities, because I don't trust their goodwill, because look what happened before. Just saying. But overall, I don't think they're going bankrupt to the next year. That's my humble opinion. You can disagree with that, but whatever. Next, we have to look at profit and loss. Well, we can see their revenue has grown year over year from $521 million in 2021 to $611 million in 2022. That's roughly a 20%, maybe a little bit less, increase in revenues. Okay, that's not bad. Let's look at cost of revenue. What is their gross profit? Well, their most recent gross profit was 611, 402 minus 185, 619 divided by 611, 402. Their gross profit is just shy of 70%. Pretty high gross profit, okay? But that's not the problem. You can see right here, advertising and marketing has exploded. Revenue has grown 20%, roughly, maybe a little bit less, year over year. Advertising has gone up 50% plus. They're spending a lot of money on advertising and marketing, and that's going to hurt their profit margin. Sales expenses have gone down. Tech and development has gone up, not really a crazy amount. General and admin has not gone up as fast as revenues. Depreciation has gone up roughly 20%. So basically, the big increase is their advertising and marketing. They're really spending a lot of money, at least in the last 3 months, on advertising and marketing. And you can see that their loss from operations is $71 million. Now, if they cut back their advertising and marketing to what it was last year, or they, cut it by a third, they would actually be profitable on their operations. They actually would. I don't know if that would be good for them, but at the end of the day, they would be profitable if they cut advertising and marketing. Just saying, okay? But that may have a negative effect. Their total bottom line loss is negative $73 million. So on the accrual basis of accounting, thanks to their advertising and marketing, they have roughly a negative 12% profit margin. So at the end of the day, this is fixable, okay? This is not the end of the world for TeleDoc. I have seen worse. Their balance sheet is really not that bad. This goodwill concerns me, but once you get rid of all that goodwill, I mean, there's no more goodwill to destroy your income statement. Their profit and loss is negative, but if they just cut their advertising and marketing, they would be profitable. And maybe their general and admin a little bit. Not the worst thing in the world, but it is losing money, and I'm not buying this company right now. And there's also another problem, and we'll see that in a second, okay? Now let's move on to the statement of cash flows. Well, this is for the 9 months ended September 30th. Number one, we can see a $9.6 billion goodwill impairment right here. That's added back. Why? Because that's a non-cash expense. And when you calculate your profit and loss, you add back non-cash expenses when you're adjusting that for from accrual to cash. Okay? If you don't understand, that's fine. Whatever. Add back a depreciation. Now, here's a funny thing right here. Stock-based compensation. Their stock-based compensation for the 9 months ended September 30th was $167 million. So if you exclude their goodwill impairment, so let's say negative 9849, 460 plus 9630, 000. So if they did not have their goodwill impairment, you just completely got rid of that, their loss would have been negative $219 million. If you look at the stock-based compensation, a very significant part of their loss is due, excluding goodwill, is due to stock-based compensation, okay? That's a pretty significant amount of stock-based compensation. As a matter of fact, we take 167 and we divide that by, let's see, 167 divided by 17. Oh, what is wrong with this? 160. Oh, I hit number lock. 1769. Their stock-based compensation expense, which recognizes the cost of issuing employees, eventually vesting and then exercising stock options over the vesting period, is 9.5% of revenues. That's pretty significant, okay? So if they didn't have stock-based compensation and they really cut their advertising, they would probably be profitable on a GAAP basis of accounting, okay? There is some hope for this business. At the end of the day, what's very hopeful is they have positive operating cash flow. They have positive operating cash flow. Why? Because of stock-based compensation. They basically pay their employees partially in stock, and that allows them to generate more positive operating cash flow. But this is a positive operating cash flow business, okay? Now, does it have free cash flow? Maybe a tiny bit. Because we could see in the 9 months ended September 30th, 2022, they spent $10 million in capital expenditures and $108 million in capitalized software. Now, people say, free cash flow is operating cash flow minus capital expenditures. Well, for a software business, I would almost include capitalized software as a capital expenditure. So they actually do have some free cash flow. $5 million of free cash flow on 1769 of revenue. 1769. Let's see, 5 divided by 1769. Okay, almost, it's basically no free cash flow. It's 0.2% free cash flow margin is what it looks like. I mean, this isn't the worst thing I've seen. I mean, there's some very bad things going on here. Stock-based compensation, a huge amount of goodwill on the balance sheet. But if they did some fixes, they could become profitable. And eventually when that stock-based compensation slows down, this may be of interest. And I'm not even considering valuation at this point. I'm just looking at the financials. So overall, the balance sheet, I'm not worried about it. There is risk with goodwill, and that could generate a massive loss if they write that down. But their balance sheet's solid. Their profit and loss isn't the worst, and they have positive operating cash flow. So this business, I don't think this business is going out of business. unless something materially changes in the next couple of years, next couple of months. I don't think it's going out of business anytime soon, personally. So at the end of the day, I'm not buying it. I don't like the dilution. I don't like the difference between free cash flow and net income because of stock-based compensation. And I'm a little concerned about that goodwill. If that goodwill ever gets wiped out and they stop having such high stock-based compensation, yeah, this may be an interesting stock. I'm slightly interested, but I'm not buying this right now. Okay? That's kind of my thoughts. Hope you enjoyed it. Cheers!